Welcome to our webinar, New Year, New Accounting Standards and New Opportunities. It is such a pleasure to have everyone here today. So delighted that we have such a great group of people attending, and thank you to our amazing panelists as well for coming together to teach us more about what in the world is this new revenue recognition standard. I mean, this is something there's a lot of confusion about. I have people emailing me personally about, whether this industry or that industry needs to get on board with this new revenue recognition accounting, whether it's only with public companies or private companies as well. And so we are here to answer all of those questions today on this new revenue recognition standard and when it's due, what the penalties are, who needs to get involved, and how to do it easily. So we would love to get your feedback and to have you as webinar participants type in your questions, and it can be as detailed as you want. You could say, hey, I am in the healthcare industry. Does this apply to me? Do I have to get on board? And you could type in even general questions. What is the best technology that we can use to help streamline this process and make it easy? So if you want to just type in your question in the IM on the right and click send, we will be answering those questions at the end. This presentation will run 30 minutes, and it will we'll leave again 15 minutes afterwards for those questions. I'm so delighted to introduce our speakers today. The first is Basil Chidi-Funk. He is a financial consultant with Simplus. Basil has an amazing background. He is currently a financial consultant with Simplus and others who he helps companies with technical accounting advice and complex accounting issues. He began his career in public accounting at Ernst & Young in San Francisco. Then he was transferred to the New York office to join Ernst & Young's national team. He was later recruited by PwC to join their transaction services team, specializing in accounting change and complex accounting, then was recruited by his private equity client to help with accounting policy, mergers and acquisitions, special projects. Moved back west, joined Lending Club Corporation. He was the head of accounting policy, and he himself oversaw the implementation of ASC606. So he is a true expert in what this means and how to go about implementing a solution. We also have Crosley Jackson. Crosley is with FinancialForce. He is a solution engineer focused on the finance and accounting solutions while aiding customers and helping them adopt new technologies to improve business processes. And prior to this role, he spent 4 years with Oracle in a similar role, supporting customers with financial analytics solutions. Then before that, spent 8 years with Wells Fargo as a financial reporting consultant focused on mutual and hedge fund offerings. So we have just really amazing talent here today to educate us on what ASC 606 really is. We also have with us Kimber Spradlin, who is every bit an equal. She is the VP of Product Marketing at Conga, and prior to Conga, she has a background in accounting and was formerly with Ernst & Young and IBM. She is an expert in IT security and contract management, and we are just absolutely delighted to have all three of you guys here in our webinar today. Thank you all so much for participating with us. Are you guys as excited as I am to get started on this new financial information? All right, I think they are. I'm going to say yes to that. So the first we would like to have Basil talk about first let's talk a little bit about FinancialForce, about Simplus, and about Conga. I'll turn the time over to Crosley for that.
Thanks, Amy, and thanks for those warm introductions. So just a bit about FinancialForce. FinancialForce is the #1 cloud ERP on the Salesforce, force.com platform. So for Salesforce customers, it's really a no-brainer to leverage a solution like FinancialForce because we are native to the platform, which means we are seamlessly connecting our front office activities with the back office, sharing objects and customer and account records across the platform. So that means no duplication of data, no manual efforts to move that data. Some solutions that we offer: financial management, professional services, automation, billing central, revenue recognition, which we're focusing today's discussion around, and the forecasting of that revenue. We are based in San Francisco. We've got 7 offices across the globe, 700 plus employees, a little over 1,400 customers at this point across 34 countries. 34 customers in 34 different countries and across 50 countries in total for our user base. Our growth has been pretty exciting, about 40% year over year for subscription growth. So we are growing rapidly, customers adopting solution as a solution grows. And we are considered a top tier solution from an investment perspective. We've got heavy backing from Salesforce, TCV, Unit4, and Advent International.
Excellent. Well, thank you so much. I'll say a little bit about Simplus. Simplus is a leading Salesforce implementation partner. We are a platinum partner who have done more CPQ implementations than any other partner. We've done more than 400 successful implementations. We have great cross-cloud expertise and more than 120 5-star reviews on the App Exchange. We've worked with more than 2,000 customers, and we have 8 nationwide offices. We have also been awarded several top company culture awards by Entrepreneur Magazine, as well as Business Insider and USA Today. But our special expertise is in CPQ, which enables companies like those of you today participating on the webinar to be able to implement ASC606 effectively and easily. Timber, would you like to talk about Conga for a moment?
Yes, thank you so much. So Conga has been on the App Exchange practically from the beginning, about 10 years now, and is a trusted name as one of the top ISV partners for Salesforce. As you can see here, over 8 million contracts generated on the Conga platform, 650,000 users operating in about 45 countries. We also support our customers with data centers and regional customer technical support centers throughout the globe. And we're very proud of our Net Promoter Score. It's in the top 5% of all companies worldwide, any category, not just within the Salesforce ecosystem. And that's really what we're here for, is to make our customers successful.
Excellent. Thank you so much. All right, well, let's jump right into understanding ASC606. Basil, I have so many questions, just so many, and I know we all do. I'm so, grateful. One day Basil and I went to lunch, and he basically just laid it all out for me one day and was like, you know what, did you know that there are over 200 different revenue recognition standards? This is why we need to make them all one. So I'm going to turn the time over to Basil to talk about the new standards and what is really involved and why we need to make this change.
Thank you, Amy. So now I've given a brief overview of the 606 standard. So ASC606 is the new revenue recognition standard known formally as revenue from contracts with customers and known informally as the standard of the century. This is a converged standard issued by both the FASB and the International Financial Reporting Standards Board, IFRS. The standard was issued primarily to improve comparability of revenue recognition practices across entities, industries, jurisdictions, and capital markets. Basically, it was issued to simplify accounting for revenue. Under pre-existing revenue recognition, there were too many guidance out there that entities had to consult to determine the appropriate accounting for revenue. If you attempt to count starting from legacy GAAP, including industry-specific guidance, SEC staff accounting bulletins, conceptual statements, and other non-authoritative guides, you'll be looking at over 200 accounting guidance. With the emergence of new technology industries such as fintech, which is finance and technology, both entities and regulators had a tough time identifying the appropriate guidance to consult. This standard 606 is intended to simplify the process and issue for everyone. The initial 606 standard was issued in 2014, and since then there have been 10 amendments, at least, issued to clarify and ease the understanding of the standard for adoption and implementation by companies. The current standard as it stands today, including the amendments, is very different from the Converge standard that was issued back in 2014. The current standard is expected to have monumental changes on how companies account for revenue, develop and execute contracts, processes and controls, financial reporting, as well as the overall systems that will be used to achieve these changes. This session today is even more important because regulators have indicated that they will be looking out for companies that have not properly implemented this standard. On slide 8, I will talk a little bit more about the standards, just add some more color. So as discussed earlier, the standard was issued in 2014 as a joint effort between the FASB and the IASB to issue one converged standard universally around the world. The extent of the impact of the new standard cannot be predicted, but we know it will vary based on the operations of businesses and executed contracts. Cost to obtain and fulfill contracts. This is a new concept introduced by the standard. This is the third column on slide 8. Certain costs to enter and fulfill contracts may be deferred and amortized over contract periods. An example of this is sales commission. So sales commission pays to sales staff for executed contracts. Now those costs have to be tracked at the contract level, and they will be deferred and recognized ratably over the contract term. On slide 9, we show 2 dates. These 2 dates are important to note. They represent the effective dates or cutoff periods for the new standard. The first date represents the effective date for public business entities. These are SEC filers. Public business entities with annual fiscal periods beginning after December 15, 2017 are expected to adopt the new standard. So think about it this way. If your company is a calendar year company going from January through December, and it is a public entity, then this standard became effective for you January 1st, 2018. The second date represents the date for private entities. The standard is effective for private entities with annual periods beginning after December 15, 2018. On slide 10, you'll see a transition for timeline. This chart shows the effective date periods for both the 606 and the IFRS. As you can see, IFRS simplifies the effective date for entities that operate in its jurisdiction, especially for public and private business entities. The FASB, which issued the 606 standard, makes a distinction between public business entities and non-public business entities with respect to the effective dates. This is consistent with the FASB's policy of giving private companies a 1-year lag to implement new and complicated accounting standards. The FASB appreciates that non-public business entities have limited resources to implement new standards such as the 606. However, I would like to point out that it takes a lot of time and effort to implement the new standard. So for private companies that have not started, you are running out of time very quickly. To implement the new standard, you have to review your contract and contracting process, assess capabilities of your systems, design new processes and controls, perform a test of design and effectiveness, implement, and test again to make sure everything is working properly. On slide 11, I will talk about the impact of this standard to businesses. As mentioned earlier, the systems will need to be evaluated. In my experience, the finance team, tech team, and consultants do a top-down assessment of existing systems and develop a gap analysis, which leads to a business requirements document to help identify technology needs. This is a very time-consuming process. For the second one, contracts. Contracts and contract processes need to be changed. For some companies, they are changing language and format of the agreements to maintain their business model, so they do not get stuck with excessive revenue deferral under 606. Another thing that companies have to do is they have to look at counterparties and their ability to perform under the contract. For example, when a contract is signed, the provider has to determine if the counterparty can afford to actually pay what the contract price is. So even if you execute a contract of $1,000, if you deem that the counterparty cannot pay $1,000 but can only pay $800, so that means when you start allocating your revenue, you would allocate based on what you know the counterparty can pay. So this actually does mean that your contracting process or vendor management process needs to be very robust to actually incorporate this. Due to the new revenue policy, tracking of data and financial reporting requirements, new controls and processes need to be implemented. As mentioned earlier, capitalization of costs to enter and fulfill contracts like sales commissions need to be tracked at the contract level. So more data needs to be captured at this point. Then lastly, for financial statement preparation, there's now a lot more disclosures that need to be included. So you need systems that can actually provide the data that will be disclosed. On slide 12, the 606 standard introduces a 5-step model for recognizing revenue. The first step is identifying the contracts. This is where your contracts and contracting process discussed earlier comes into play. First, you have to determine, has the contract been executed? Who are the counterparties to the contract? Can both counterparties perform under the contract? Then step 2, identify performance obligations. Here, you identify all the performance obligations under the contract. Think about it this way. You're identifying all the promises you are making to each other under the contract. And this includes all the sweeteners or incentives that you have included. Under legacy GAAP, which is the old GAAP 605, there could be free goods or services offered to customers with zero revenue recognized. However, this is not permitted under 606. Slide 13. So here, we focus on steps 3 and 4 of the 5-step model. Step 3 involves determining the contract price, contract price or transaction price. Here, you have to determine the full price of the contract, then identify the standalone value of all the promises and obligations that are being made under the contract. Then on step 4, you now go and do an allocation. So once you determine the contract price and identify all the promises and obligations being made under the contract, you have to go back and do an allocation. For step 5 on slide 14. Here, so after you've identified all the promises you're making, then determine the contract price, and then done the allocation in step 4. Then for step 5, you start to recognize revenue as you deliver on your promises and satisfy your performance obligations. Here, companies also have to do a parallel analysis to see what revenue would be like for contracts under 605, which is the legacy GAAP, compared to 606, which is the new GAAP. This is very important for disclosure as well in the financial statement. In slide 15, we talk about the transition process. The first part is you recognize revenue on the old standard up to the transition date. Then once the transition date happens, then you set up your contract under the new 606 model and you start to recognize. Especially in cases where you have multiple element deliverables, you would have to identify all the promises that you're making, do your allocation as described in the 5-step process. Then from step 3 here, you start to recognize revenue as you are delivering on your promises. Then at the end, you do some sort of catch up. The FASB gives 2 transition application methodologies. The first is the full retrospective methodology. Here you have to restate all revenue for all prior periods for comparability. So this way users of the financial statements can see how the 606 standard would have impacted all years that you present in your financial statement. The next one is the modified retrospective. Here, you only look at contracts that are still in effective or contracts where obligations have not been fully satisfied as of the effective date. So let's look at an example here. If a contract was entered into in March 2017 and it's a 6-month contract, by September 2017, that contract to be done. So at the effective date, there will be no adjustment needed to be made then. But assuming the same contract was entered again in September 2017 and goes through to March 2018, as of the first of this year, assuming you're a public business entity, you would have to go and look at that contract and say, okay, I've only performed 3 months under the 6-month contract. So let's look to see how would revenue change now that we've gone from the 605 into the 606 standard. On slide 16, this chart shows the relationship between a contract and the performance obligations within the contract. So think about the contract as the legal binding contract that you signed with the customer, and then the performance obligations under the main contract or the master contract as little contracts or smaller contracts that you are held responsible for. So those little performance obligations, those produce the revenue source data that's used into your ledger and accounting system. Slide 17. Here we see visual representation of step 3 and step 4. I remember earlier we discussed step 3 is determining the transaction price and step 4 is allocating that transaction price. Here we focus more on the multiple element arrangement. If a bundle of items is sold together, the total value of the bundle must be fairly allocated to each item. On the next slide, we will do an example to further illustrate the treatment of this. So on this slide, you see 2 charts. On the left side, that represents legacy GAAP. So on the legacy GAAP, you could have an agreement where you would have a $3,000 contract, and on there you have 3 obligations. You have 2 main obligations. One of them is deliver software and support. Then you maybe throw in a freebie, which is the consultancy part. Under the new GAAP, you have to go and where you have to recognize that the consultancy part actually has a standalone value. So you determine here that even though the contract is $3,000 and you determine the value of the software and support to be $2,000 and $1,000, you actually have to do a relative fair value allocation. So where you see the standalone price, we've determined the actual value of this contract is $4,000 because it's $2,000 for the software, $1,000 for support, $1,000 for consultancy. When we do the fair value proportion, we look and determine, okay, the software does actually represent 50% of the total contract value, and then the software and consultancy each represent 25%. So we go back and reflect this allocation on the contract we have executed with the customer. So here we've determined that the value or revenue we will recognize from delivering the software is $1,500. The value or revenue we'll recognize from support is $750, and the revenue from the consultancy is $750. Hopefully this example helps you understand the allocations and their multiple element deliverables. Thank you.
Basil, this was so helpful. It really helped me understand a lot, especially the slide 18 I felt was really visually appealing because I understand now why I cannot offer freebies to everybody and not expect to, recognize that revenue on the back end. So thank you so much. So that actually makes me want to get rid of some freebies. So Crosley and Kimber, thank you so much now for helping us understand what we can do to make these changes easily and how we can use technology and use FinancialForce and Conga and Simplus to help streamline this process. Yeah,
absolutely. So let's take a look at the 3 components that are involved here. First is your CRM system, Salesforce, customer relationship management system, and that is really where the whole process begins because as Basil said, we now have to really understand a lot about the sales component of the process in order to properly recognize the revenue. Within that, contained inside of that system, is the quote to cash life cycle. And then finally, that flows into revenue management, the FinancialForce end of things. So let's go on to slide 20 and look at that in a little bit more detail. I think it's important to understand ASC606 within the context of the wider business process, because the whole goal here is to generate the revenue that we then have to worry about recognizing properly. So the first step in the process, we're going to go all the way back into uncovering actionable data. So that is really the sales reps' day-to-day activities, right? So as you're trying to engage with your customers, prioritizing your accounts, finding your opportunities, beginning to form a negotiation or a plan for how you're going to win that business. Then you're going to generate your proposals, present your value to your customer, the things that you do to engage and win that business. Successful there, and now it's time to configure price, give the customer a quote, something fairly official, right? And there's little bits of information that actually impact revenue recognition. So it's important that it's all contained within a single system. In some cases, then you may negotiate that contract with your customer, master service agreements, statement of work, even starting with NDAs before you conclude your business negotiations. Again, making sure it's all contained into one system. Process the billing, generate the presentments, that's the official document, the invoice, recognize the revenue, and then hopefully continue in with that relationship with your customer in a renewal cycle if you're on a subscription basis, selling additional products, etc. It just depends on your business. So let's take a look now at slide 22, and specifically I want to focus on the contract aspect, and that's because that's my area of expertise. One of the things that's really important is we have got to raise the compliance, visibility, and controls inside of our contracts. So no longer can contracts be physically printed and put into a file cabinet. And you might be surprised to learn that there are still a number of companies that operate that way. Certainly some have begun to consolidate and put into a secured Google Drive box, something like that, to consolidate those contracts. But it really needs to be brought into this system of records so that we can understand not just the business terms in the contract, so not net payment of 30 days and what the discounting, as Basil gave that example for, but also the legal clauses. There's a lot of information contained in those that impact revenue recognition. So storing all of that and into Salesforce, where you can track the history of the changes, have version control, be available to search inside of those contracts and across all of your contracts. And during this transition period, really understanding what the renewals look like and what contracts may need to be renegotiated or have some of the legal language changed, even if you maintain the same business terms, such as the discount that you've offered to those to your customer. There may be changes that you still have to put into the contract at the time of renewal. So that's very important during this transition process. And tracking all the information that impacts revenue recognition is critical. Beyond in 23, we can also see benefits to the organization beyond just the ASC606 compliance. So really gaining visibility into the entire negotiation process at an enterprise or a departmental level, being able to easily make those negotiations inside of Microsoft Word without losing track, as we said, of the version controls. And most importantly, reconciling the data back to the system of record, which in this context is Salesforce, so that all of these different systems and components of the ASC606 06 compliance efforts are using the same data. I think that was brought up at the very beginning of this. It's not about copying data or replicating data. It's all of us looking at that same core data and coming up with the same answer. But at the same time, keeping the sales teams operating inside of Salesforce where they're comfortable. So you have the sales team operating in the platform that they use all the time. Your accounting team operating in their platform is really important. And finally, achieving insight into where and why contracts stall. That's not necessarily ASC606 related, although it can be, but it's really important for the business. We hope to have lots of revenue to recognize, and it's critical to understand where these contracts are stalling, what's causing them to stall, and what we can do to keep that from happening. All right, and with that, I'm going to hand it over and we'll look at a little bit more of the CPQ component of this three-part process.
Thanks, Kimber.
Thank you so much. Go for it, Crosley. I was just going to punt that ball right over to you.
Appreciate it. Thanks, Amy. And yeah, we're just going to continue the discussion, and we've got a couple more visuals to help understand the process as well as where the solutions fit into and act as pieces of the puzzle here. So just looking again at the new RevRec standard here, you know, these steps are represented by the detailed components of the new standard, and many of which we've discussed, and Basil went into great detail of for us. But below that, you can see how the various solution sets, and Conga is certainly in there as well, are a part of the equation, right? So in the contract management piece, if you're using Salesforce CPQ, configure price quote, to manage your contracts and generate presentments with Conga as a solution, that's going to be on the first half of the equation, so to speak. But then as we start to separate out revenue contracts and the underlying performance obligations, determine transaction price, allocate, and then recognize revenue, that's where FinancialForce comes in. So you can see some layering of the solutions and how they work hand in hand. And one other thing to note here is a nice cliche for you. At FinancialForce, we do drink our own champagne. We are leveraging our own solutions from revenue recognition as well as the financials piece. But also Salesforce CPQ, and the partner on the line today, Simplus, has helped in the implementation of CPQ and making sure that everything is working appropriately for CPQ and revenue recognition for us. So on to slide 25. You know, this is a cyclical view of how we like to try to represent the customer life cycle or the customer journey. So starting from opportunity, and as Kimber mentioned in your CRM Salesforce solution, you can see how various sort of spokes in the wheel aid in the process. And one big thing to note here as we kind of step through, you know, we have the Salesforce piece and financial services automation if you're a projects or a consultancy sort of operation services based operation, then into the billing and the financial management piece, is that everything here, of course, is on the Force.com platform. And if you tune into any webinars or a part of an engagement that I'm on, you'll hear me mention that quite a bit because I think it's very important, right? When you're on the Force.com platform, you are able to leverage same customer records, same customer opportunity. And what that does is it minimizes the duplication of data. In fact, it eradicates the need for duplication of data, and you're sharing those records. So there's no passing of information. It's simply a resurfacing of information in these various business process applications that enable you to really gain on efficiencies, accuracies, time management, better use of your resources. So as we move on to slide 26 and look more closely at the solution at hand in revenue recognition, this is certainly a simplified slide, but you know, the automation piece, again, getting all that data on the single platform, right? So historically, with a solution or a process, I should say, a revenue recognition, a lot of the customers that I work with are doing this in spreadsheets and then making transaction entries into the ledger, either one single entry to recognize revenue or line by line into the ledger after they've made their calculations in their spreadsheets. Now, of course, We all know and love Microsoft Excel. It's got a great spot in everyone's heart. However, there are limitations when it comes to the importance of recognizing revenue and moving your balances from deferred to sales. So when you bring that process online, the benefits are allowing you to leverage all those data points that are already online. If there are changes made to the source data, wherever you're pulling the data from, those changes will flow into the revenue recognition engine, so minimizing the concern for inaccuracies or challenges with capturing your data appropriately. Forecast ready, so any of those data sources that you're leveraging, you're able to also forecast out. So if you're looking at a revenue contract and you're making those entries from deferred to sales on a month-over-month basis, and you want to see what revenue is coming down the pipe by performance obligation, we have the flexibility to do so. Real-time reporting, Kimber certainly talked about some of that, but also leveraging, as you can see on the screen here, a side-by-side comparison, which is part of the standard requirements of 605 and 606, recognizing the difference between the recognition standards. And then native to the Salesforce platform, I think I've beaten that one pretty good. So you get the idea, leveraging those same sales source objects, allowing you to be consistent and gain some efficiency in the data process flow. Onto our summary slide here, and this is a bit of a build slide, but the first one is recognizing or leveraging the new revenue contract and performance obligation component. I thought Basil did a really nice job explaining this actually in the multi-element arrangement component, revenue contracts, and how performance obligations are now a part of the world we live in with our contracts in a one-to-one or an end-to-one relationship, and enabling the process being a fairly complex one, but the solution enabling you to achieve those multi-element arrangements. Next being the automation and calculation. The big one here is being able to calculate your allocated revenue based on your standalone selling price, and then amortize the contract costs as well as revenues based on those performance obligations with the FinancialForce revenue recognition engine. And then lastly, the retrospective and parallel analysis. This is that some of the catch-up comparisons, the real-time reporting, the current versus new standard, and giving you some real transparency into the impacts of the changes, as well as the ongoing aspects of your contracts. So 5 key takeaways. What have we learned? This is a quiz and everyone needs to fill in the blanks. Just kidding. So number 1 is, again, centralizing your data, right? Bring it all into the platform, allowing us to leverage the force.com platform and not have to rely on data inflows and outflows, extracts, manipulation, and so on. Leverage the platform for one of its greatest strengths, which is once your data is there, you can utilize the applications therein to really speed and create greater efficiencies in your processes. Number 2, integrating that front office CRM system with the back office, really engaging your customer, increasing retention with your customer because of the high touch points of CRM, and having those impacts flow into the back office. Number 3, allowing flexibility with the process, right? So, with the comparison tools of 606 versus 605, multiple data sources. Again, can't say it enough. If the data is on the platform, you can leverage it as a source data point for your revenue recognition process, and that really provides customers with a lot of flexibility in how they're going to approach the process for their own particular revenue contracts. Number 4, that real-time audit compliance. Everything that a transaction that's committed into the FinancialForce set of applications creates a record. So it really gives you a lot of transparency, a lot of confidence that not only were transactions committed, but by whom, when, why, where, a lot of confidence in how that process, those processes are executed on. And then number 5 is the ability to build relationships, deliver on the value that you've promised to your customers because you have that transparency at your fingertips. You've got visibility into your data and why the particular occurrences are happening, and how to best interact with your customers.
Crosley, thank you so much. I think that made everything very clear and easy to understand. So now, these next steps, first of all, call us or email us. And then we're also going to take a few questions from our webinar attendees. Are Crosley, Kimber, and Basil, are you guys ready? You ready to be thrown the hardball questions? Great. Okay, cool. So one of the questions that one of our attendees has is, what happens if you don't implement ASC606? This question is for Basil, and Crosley and Kimber, please also answer if you have some thoughts on this. But what happens if we don't? You know, there's so many people who think that this doesn't apply to them, or maybe they get started too late. But what are the consequences?
Well, thank you. First of all, I think ASC606, think of it this way, it applies to everyone. If you want, the only way you can tell if it doesn't apply to you is you have to prove it out, which means you have to actually, and what I've done for my clients is, hey, we say, okay, look at what your revenue is under legacy GAAP, then look at what the revenue is under new GAAP, analyzing the same contract, and then it should get you to the same conclusion, and that's how you prove it out. Well, if you don't do it, there are several consequences to your company, and I think I look at it in two ways: the internal consequences and the external factors. So the internal consequences is, one, you will have a deficiency in your process or controls from either from the manual side or from the IT side, or both. And secondly, this will impact your forecasting process, because now you should be forecasting your revenue using or incorporating ASC606. So if you're not using that, then you have to view your forecasting process as being flawed, as well as the actual data that you are producing. And then third, for the internal, I see impacts to your tax planning. If you don't properly forecast revenue, then you're not going to properly plan for your taxes. From the external side, I see a few issues. One, if you're a public company, you will get a comment letter from the SEC asking you why you haven't disclosed the impacts of ASC606 and how you got to that conclusion. And the SEC has indicated that this is going to be a big area for them, and especially now that it's now effective, they're going to be looking at a lot of companies across the board, both large public companies and smaller public companies. And then secondly, if you don't properly implement it, you could have an error in your financial statements. And if you have an error in your financial statements, this may lead you to a restatement. And a restatement is not something companies want to deal with, because a restatement leads to loss in investor confidence or the market confidence, impacts the valuation of your company, and it's just a headache that everyone tries to avoid. So the pain involved in not properly implementing the 606 standard is so severe that even though you think it doesn't have an impact, you still should try to prove it out.
That's an excellent answer. Crosley or Kimber, do you guys have anything else to add about that?
No, that was pretty thorough.
Yeah, I'm not going to follow that.
I'm a little scared myself. I'm going to go look at my records. So is there any kind of business that's outside of the scope of ASC606, or does this apply to everyone?
So every company should view it as that it applies to them. However, the FASB has given exceptions or exemptions to certain types of contracts, because again, the 606 applies at the contract level. So the FASB has said there's certain contracts that are out of scope of this standard. So an example is the lease contract. There's a new leasing guidance that is effective in 2019, and that is the next biggest standard after the revenue standard. The FASB spent so many years drafting and preparing that contract that they've said, okay, that if you're in the business of leasing, don't worry about 606. You've got the new leasing standard coming out, and that is what you should focus on. Another is certain insurance contracts. The insurance industry is a beast on its own, so contracts in that industry are exempted from 606, as well as certain contracts that relate to financial instruments. So these are like derivatives and hedging contracts. Those contracts are also out of scope of 606 standard. But overall, every company should view it that it has an impact and just try to prove it out that if it doesn't, and try to figure out what other impact, if not directly to your financial statements, but to your contract process or processes and controls.
Okay, excellent. That's very helpful. Thank you. This next question is for Crosley, and Basil touched on this just barely in one of those questions. Is could you expand on the forecasting issue and how FinancialForce and Salesforce CPQ and Conga can help expand on those forecasting capabilities to make that a great opportunity for businesses?
Sure. Maybe I'll start and pass to Kimber for the Conga piece. But from a FinancialForce perspective, if you consider sort of the nuts and bolts of what we're doing with revenue recognition, right? We're carrying a deferred balance. We accept money. We need to defer it because we're not actually recognizing it until certain obligations have been fulfilled. Once that's fulfilled, we book it into sales. So the forecasting piece is just the flip side of that, right? Other side of the coin is, what do we have to look forward to from a deferred balance that's coming down the road here by not only revenue contract, but also the obligations therein. That covers, the revenue contracts, but if you're also looking at singular objects or records, you can also forecast off of those as well. One sort of nice thing about the forecasting piece, and there's a lot of flexibility there as well. You can add profiles. So if you've got seasonality in your business, you can add seasonality. So it's a nice flexibility for looking at things not just in a singular view, but how your business actually operates and the revenue that it collects.
Great, thank you.
Yeah, exactly. It's really there's forecasting that even happens prior to the contracting stage, of course, because we all have 4, 5, 6 levels of sales stages in our organizations, and it's about the visibility going all the way upstream, even before you've begun to issue contracts, so that you have some sense of what's coming, both in new business and renewal business.
Okay, thank you. So if we're using a solution, we have time for just one more question, and this is for all three of you, but especially for Crosley and for Kimber. If we're using a solution like what we are proposing, Conga, FinancialForce, and Salesforce, where can customers really make gains in their processes? What will this suite of technology really do for them?
Sure. Yeah. I mean, I think that a lot of the themes that we've touched on today are of paramount gain in that think about automating where it's appropriate, right? When we say automate, you have your data available to you. Bringing a process online in line with the rest of your suite of applications, right? Obviously, we're big proponents of the Force.com platform, but having worked with different technologies myself, and looking at what is usually the biggest challenges for organizations, it's getting data in and getting data out of whatever application it is you're using. So if we can eradicate or remove one of those components in getting the data in, right? If it's already on the platform, then that's a big win for us as organizations and as business users. And you don't have to second guess your data. Have questions on the source of it, who touched it last, which version are we on, right? And of course, I'm alluding to other applications, and then the Microsoft Offices of the world. Those are really the big gains, because you have so much transparency in the process, and tools that aren't necessarily meant for these really important business challenges that really rely heavily upon the success of the business can be put to the side, and we can rely on something that's more built for organizations from small business up to through to the enterprise.
That was an excellent answer.
I couldn't agree more. This is a big area to tackle, and there may be a sense, well, 3 different systems, but it's because you're involving multiple business processes, and so this really provides you the best of all worlds. You have systems designed specifically to meet the requirements and needs of the departments and the business processes, while all relying on a unified set of data so that we're not moving data in and out. The other thing that bringing all of this together into one platform and implementing automation is the compliance and the enforcement. So with that automation, you can really remove a lot of steps out of the process for the end user and enforce compliance, so that they just have no way around it. In fact, they don't even see what's going on in compliance enforcement steps. That also creates efficiencies. It ensures that people have more time for their core job functions, so that your sales team is spending less time on administrative tasks, that your accounting team is focused on the high-value activities necessary. Same with your legal team. And finally, you get some global reporting and analytics that gives you the ability to identify issues in the process, look for process improvements, and make changes much more seamlessly, rapidly than you would be able to do otherwise.
Kimber, that was an excellent summation of why we're doing what we're doing. So if I understand correctly from everyone, if we implement this suite of tools, we're going to reduce our errors, we're going to be faster, we're going to be more efficient, we're going to have government compliance, which is obviously very important. We're going to increase our transparency and our trust among the stakeholders. We're going to generate a positive ROI, and we're going to have analytics for future forecasting and be able to better run our businesses. Is that fair to say? That's what these tools are going to do for us?
It sounds pretty amazing and unbelievable. But within this area of the business, that's really why you bring this all together, and that's why you have somebody like Simplus, who understands all 3 of these platforms and is able to really take on the burden, have the expertise to harmonize everything and make sure that they are working for each of your businesses, because each of your businesses and how you process things and who has to approve them is slightly different. And so that is a key component of success.
Absolutely. And thank you so much for saying that. Thank you to all of our attendees for participating today, for fielding questions, and for joining us. And Basil, Kimber, and Crosley, thank you so much for joining us. This was enlightening to me, and I know it was to all of our guests as well. If you have any information that if you'd like to share or get in touch with anyone, please email us at info@financialforce.com, info@getconga.com, or success@simplus.com. Thanks so much.